Imagine scrolling through real estate listings and finally spotting it, a home that fits your life, listed at a price perfectly matching your budget. But then you look at this mortgage calculator. Even with that reasonable fixed asking price, the actual monthly payment is hundreds of dollars higher than you expected. The math is being skewed by a disproportionately large block of interest. You decide to look at a used car instead, only to find the exact same problem. The sticker price looks manageable, but the financing makes the monthly loan payment completely unaffordable. The calculator visualization shows this happening across the board. The interest bars for auto loans are climbing. Even your credit card statement is generating aggressively larger interest charges month after month, even if your daily spending habits haven't changed a bit. Rising interest rates are now the primary driver of these expensive monthly bills, essentially taxing your ability to borrow money for any major purchase. The average consumer's borrowing power has been severely reduced, and the leverage dictating exactly how much you pay on every one of those loans sits with one institution, the Federal Reserve. The Federal Reserve serves as the central bank of the United States. The people sitting around this table set monetary policy for the entire country. They operate under a specific set of mandates. Their primary goals are to control inflation, support maximum employment, and maintain a stable financial system. This balance scale demonstrates how they tackle high prices. When inflation rises rapidly, the Fed pulls up the interest rate lever, making borrowing more expensive. This restricts the flow of capital. If loans cost too much, people and businesses borrow less. When people stop borrowing, they stop spending. That reduction in demand leaves businesses with excess inventory, which halts the cycle of rapidly increasing prices. The financial squeeze you feel on your auto loan or mortgage is the direct result of this balancing act. The Fed restricts your borrowing power today to prevent unchecked inflation from permanently destroying the value of your dollar tomorrow. This deliberate slowdown cascades through the entire economy. When businesses face higher borrowing costs, they pause their expansion plans and slow down their hiring. At the consumer level, this macroeconomic policy triggers immediate, automatic increases to any variable interest rate you hold, especially on your personal loans and credit cards. When the news eventually reports that inflation is cooling off, the natural expectation is that those rates should instantly drop. Millions of homebuyers expect their mortgage quotes to fall the very next day. This chart shows a disconnect between cooling inflation and mortgage rates. Unlike a credit card that adjusts month to month, a mortgage is a 30-year bet made by investors who watch Treasury yields and the Fed's future signals. If those investors believe the Fed will keep its benchmark rates high for another year to ensure inflation is truly dead, they will continue to demand high interest today to protect their future returns. The Fed calculates a specific risk. If they cut rates too early, cheap money will flood the economy and inflation will accelerate all over again. Because of that risk, policymakers hold interest rates steady. They wait for concrete, sustainable evidence that inflation is securely moving toward their target before they loosen the valve. Investors fully anticipate this drawn-out, cautious approach. Because the market expects the Fed to hold firm, lenders keep their rates elevated, meaning immediate relief for your monthly mortgage payment is not coming overnight. We are operating in a specific financial environment. The era of ultra-cheap borrowing is on pause. Knowing this, your immediate financial priority should be aggressively paying down any balance on your high-interest credit cards. Credit card debt requires urgent attention because those variable rates compound. In a high-rate environment, they drain your daily cash flow faster than any other financial product. Next, work on improving your credit score. When loans are expensive across the board, a top-tier credit score is your best tool for securing the lowest possible rate a bank is willing to offer. If you are planning to buy a home or a car, prioritize saving for a larger down payment. By reducing the total principal size of the loan, you minimize the amount of money exposed to those high interest rates. Finally, rigorously compare multiple lenders. A fraction of a % difference in your rate saves thousands of dollars over the life of a loan, so do not accept the very first offer you receive. You cannot force the Federal Reserve to cut rates, but by understanding the mechanics of how and why borrowing is expensive, you can actively protect your wealth through smart daily decisions, rather than waiting for the market to fix the math for you.